Good afternoon, good evening, everyone. Myself, Alok, and on behalf of entire FPSB India team, I extend a very warm welcome to all of you joining us today in this webinar. And webinar topic for today is the tax strategies for investment decisions. So, friends, as a financial planner, we know that successful investing is not only about identifying the right opportunities. I would say it's also about maximizing your post-tax returns for the clients. So, with evolving tax regulations and changing investment options, understanding these tax-efficient strategies, it has actually become a very essential part of delivering value to the clients. So, friends, today we are fortunate to have with us an expert in this matter who brings deep knowledge and practical insights, I would say, into this very important subject. So, today's session promises to help us better align investment decisions with tax planning and enabling to serve our clients more effectively. So, it's my pleasure now to introduce Harminder Garg, the CFP professional, and also our chief mentor of IIFC. So IIFC is a premium education provider of FPSB India, and Harminder's guidance has enabled hundreds of candidates to successfully clear the CFP certification. Harminder has also been honored with the Education Provider of the Year award and also the Champion Educator award by FPSB India. So he has over 2 decades as a CFP professional, and he continues to contribute, I would say, actively to the CFP community. And also academically, he holds a PGDM in finance from IMT Ghaziabad, and he is a postgraduate qualified in financial advising from IIBF. So with that, Harminder, I would like to hand over the stage to you. Over to you, and thank you so much, and a very warm welcome to you, Harminder.
So thanks, Alok, for giving this detailed introduction. Good evening, everyone. A warm welcome to join this session on the topic tax strategies for investment decisions. Let me start with a simple example. So there are two investors who are earning the similar return on their investment portfolio, yet one investor take home significantly higher money than the other investor. So how it is possible? The answer is very simple. It's not about what you earn. It's about what you keep. So taxation is a silent partner in all of your financial decisions. Today, we will discuss 8 real-life case studies in this session. Post this session, you will get a confidence to handle any type of situation in investment decision making which involve taxation, and you can plan your investment in more taxation effective way. So in this case, the one disclaimer I just want to make, because this area is focused on tax advisors. So this session is for educational purpose. For your personal tax filing return, I recommend that you should consult your tax advisors. So let me start this session. What we will cover in today's session. So our session objective, so there are main 4 objectives which we will cover in this session. As a CFP educator in the last 20 years of experience, what I feel that the basic nitty-gritty of income tax related to the rebate and exemption, basic exemption limit, is not understood by the common investor and in some of the cases financial advisor properly. So we will touch upon in detail about the rebate and basic exemption limit in regard to capital gain. Second, we will discuss the taxation of intraday trading in capital markets and derivative F&O income. So what is the taxation aspect in these type of trades? So that is the second objective which we will cover. Third, we will cover loss harvesting. So set of provision for capital gain and business income, right? So how to plan in a better way that the loss you can do in such a way that you can work, that loss becomes a tool to set off your, save your taxes. That we will discuss in detail. In the last topic, we will cover that as a tax planning strategy, that how we can plan tax deferred investment, right? And in that, when we make the investment in the name of minor and then redemption later on, when the child becomes major. So how to plan this to save taxes? So these are the four major topics which we will cover. Our session format is, right, so the session format is little more interactive. So this is like, we have these 8 case studies. So first, I think I'll run through 4 case studies in which you have to just understand by 15-20 second understanding the question and just put yes or no in the chat box. We will discuss the legal aspect and then the solution of this case study. But what is your current understanding before moving forward? First, we need to understand what we know. Then we will understand what law says and what is the actual answer, what income tax says. So these aspects we will cover in this format, and I request everyone to participate. You need to answer yes, no. One thing is, in all the case studies, we will not refer any old regime aspect, because as on date, most of the 80, more than I think decent number of assessees moving towards new regime. From 23 financial year 23-24 onwards, that new regime is by default regime. In case you need to opt for old regime. So it's so the session whole objective is covering only and only on new regime aspects. So this is the first thing I think we need to take care. All the things which we will cover today, so we will cover from Income Tax Act 1961, right? For which is applicable for this year filing of return, financial year 25-26, assessment year 26-27. But as we go through, there is no change, because now this tax year 2026-27, the section change is there. The topic which we are covering, there is no change, just change of sections only. The provisions remain same. So this session is relevant for current financial year tax filing, as well as the running tax year, for which your returns filing will be you will be filing in next year. The provision, we refer everything, so there is no change in provision, which those provisions we are covering today. So that's the one point, I think, one idea which we are covering now. So let's move to the first case study, and then I think maybe in this case you can, this is a chat, I think I'll just everyone, this is the case study, and request everyone, I think we need to is case में, is it Alok sir, isme in this case, is it on to everyone to participate? So my point is, everyone can just mention yes or no in this chat.
They can do so in Q&A also. They can do so in Acha. So
let's
Rutika
ask
is the
them
chat.
to do on chat only.
Rutika, the chat tab is showing as disabled. Can you just enable that?
Sure, sir. I'll do it. It has been enabled.
Great. So I think in this case study, Mr. Raj, age 45, is a resident individual filing under new tax regime. He has 8 lakh business income and 3.5 lakh short-term gain debt from debt mutual funds. Total income is 11.5 lakh. we need just one quick answer from you, that in this case, is it yes, rebate 87A is available on specifically on short-term capital gain on debt mutual fund? Yes or no? So request, I think we have a 10 seconds. Please, everybody participate. Then you learn more in this case. If you participate, in that case, you will get a better understanding. We will cover only individual and HUF in this case. 5 more seconds. I think you can participate quickly.
You're getting good response, Harminder.
Yes. Everybody will participate because this is a structured learning where you will participate and then this learning will enhance in that way. Okay, great. So I am moving toward that second case study. So we spend around 15-20 seconds on every case study. Then I think later on we will cover in detail. The baseline Gotham is having a similar profile, but the having a business income of 7 lakh and short-term capital gain on equity mutual fund, 4 lakh rupees. Now the client is asking that 87A rebate is applicable on short-term capital gain on equity mutual fund, yes or no? The short-term capital gain which is applicable, is it applicable, yes or no? That is the question. Yes. Now moving to the third slide. So in third slide, the profile Mr. Surender is having 62 years of age. And in the third slide, he's having a business income of 10 lakh. And long-term capital gain on equity mutual fund, 6 lakh rupees. Total 16 lakh of income. Now he want to check from you that is he eligible for rebate under section 87A on long-term capital gain on equity mutual fund? Yes or no? For this question, I'm still waiting for your more responses. I think everybody should think about this and give your response, yes or no. Because the picture here is that the total income, okay, the total income, okay, great. I think this is the one thing. Now we move to the next forward point in this case. The fourth case study. Then now post that we will discuss on these legal aspects on this. So in case 4, the taxable interest income of a client is 1 lakh rupees. And the short-term capital gain on equity mutual fund is 2.8 lakh. So total income is 3.8 lakh. Now he want to understand that this short-term capital gain on equity mutual fund is in this case eligible for basic exemption limit benefit, yes or no? Great. So I think this is a good amount of participation from everyone. So this is, thank you so much for acknowledging this. And this is now we move to the what law says. So we will understand the provision in a very simple way, right? So in this case, what law says now. So step by step, we will discuss on that. So first we need to understand, because in these 3-4 slides, we will cover complete capital gain. It's so simple. Now the post this recent changes in the Income Tax Act from in the last year, the taxation is very simple now. So what there are, so now first we will discuss about long-term capital gains. So there are 2 sections for long-term capital gain. First section is section 112A, right? So this section is applicable when there is a, so the condition for there is like there is a long-term capital gain on listed equity shares or equity oriented mutual fund, right? So these two major categories, and there is a STT applicable on, in case of shares, buy and sell both. In case of mutual fund, on the redemption, STT, if it is applicable, then this section 112A is applicable. Apart from this, all other long-term capital gains falling under section 112. So in the section 112A, the client is eligible for 1,25,000 exemption. So suppose anyone is having more than 3 lakh capital gain. It means the tax will be applicable on 3 lakh minus exceeding amount. So 125 is exceeding, 175 is exceeding more than 125. So the taxation is applicable on if the total long-term capital gain is 3 lakhs, so on 1,75,000. And the taxation rate is 12.5. So the section 112. So apart from this equity share and equity mutual fund, for all other things, right? This all other things, non-equity long-term capital asset, the tax rate is 12.5%. So now the fourth point, which is I think relevant to related to the, which is related to our case study. So what law says, so very important, just read this because I think first three condition everybody aware, but I need to cover this fourth point. Law says that in case of a resident individual or HUF, if the total income excluding such long-term capital gain is below the basic exemption limit, the shortfall can be adjusted against long-term capital gain under section 112 and 112A, and tax is charged only on the balance. So this law language says that if anyone is having no other income, right, or lesser income than 4 lakh, so the basic exemption limit in new tax regime is 4 lakh rupees. So the exemption, if the income is like we discussed 1 lakh interest income, so in that case, that long-term capital gain 3 lakh of rupees is adjusted against that basic exemption limit. So it means in that case study which we are discussing, right? So in this case, I think first I'll just cover the slides that in India, this up to 4 lakh, the taxation is nil. So the basic exemption limit is 4 lakh rupees. So anyone is having 2 lakh interest income, then that person can adjust remaining 2 lakh from this short-term gain or long-term income that can be adjusted. So this is the section which we need to refer to understand in this case. So this is section, this is the case which we covering. Now I think if I cover this case study, which we discussed just now, in this case study, it's very simple now. There is a 1 lakh taxable interest income and the gain of equity mutual fund is 2.8 lakh. So in this case, that can be adjusted against basic exemption limit. So the answer is 0 tax. This is adjusted against this. So this case study, I think we will, other case studies we will discuss with the calculator, but this is very simple in that way because basic exemption limit benefit is available for long-term capital gain of any type. It's not only equity 112, 112A, or even all type of short-term capital gain. For all, this basic exemption limit benefit is available. So this is first slide I think we covered. Now we move to the second slide. So this slide which is explaining the section 111A. So if you sell equity shares or equity oriented mutual fund, so I think the similar thing which is we've discussed in under section 112A, more than 12 month long term, less than 12 month short term, right? In this case, if the STT is also applicable, then this is eligible for special concessional rate of 20% instead of normal tax rate. So all other type of short-term capital gain is computed under section 45. I think we will cover in the next slide. Only this short-term capital gain is covered under section 111A at a concessional rate, right? So this is same. I think in this case, you will get a concessional rate of 20%. This section understanding is very important to answer those case studies. That's why we try to cover the law part, that what law says in this. Okay. So short-term capital gain other than covered under section 111A. In case of long-term capital gain, there is a section 112A and the another section is technically 112. But for short-term capital gains, there is no 111 section. For all other type of short-term capital gain, the taxation provision is given under section 45 of Income Tax Act. And in this case, apart from this 111A, for all type of short-term capital gain, normal slab rate, so marginal tax slab rate is applicable. So in this case, if this marginal tax rates are applicable, so in this case, this 111A, so this generally, this is rebate under section 87A. So the first case study which we discussed, this case study which we discussed, I'll just quickly move through. This case study which we discussed, in this case, short-term capital gain on debt mutual fund 3.5 lakh. Even this is become 12 lakh also. If anyone is having a short-term capital gain on debt mutual fund on the recent redemptions of the, I think, post 1st April 23 investment, we are talking about investment made post 1st April 23, any short-term capital gain. So 12 lakh whole capital gain can be claimed as a rebate. So that if suppose in this case, the short-term capital gain is complete 12 lakh. So in that case, the answer for this case study, first case study is yes. 87A rebate is allowed in this short-term capital gain, only where we are not getting on 111A, where the gain is from listed equities or equity mutual fund. Only that is the exception, right? So this is the point I think we cover in this. Now this is the last, this is the main, in this case this is the main slide, and then rebate slide is we need to discuss in detail. So section 115 BAC, that section is very important to understand because this section is connection with almost every provision. This section says, this section is applicable to individual or HUF. This section says that you will get lower tax slabs in comparison to old tax regime slabs. But in that case, you need to trade off between deductions and exemptions. So a lot of exemption deduction under you will not able to get. So this is India follow the progressive taxation structure. I'm sure everybody of you understand how the tax is calculated. So there is a 0 to 4, nil, 4 to 8, 5%, 20,000, 8 to 12, 10%, then progressive 40,000. So slab wise, this progressive taxation structure is applicable in India. So this is 115 BAC. This section is very important when we read the section rebate. So this is rebate section. I think the case studies which we are discussing, we discussed why this special income cases which we are discussing where rebate is not allowed and how to understand this. Very important. So this is as it is, I copy the law language, because if you just copy paste from the net now, then in internet, then you will not clearly get proper understanding of this. Each and every word is important in this. So what rebate under section 87A says that where the total income of resident individual assessee for any tax year is chargeable to tax under section 115 BAC, then from income tax computed before allowing the deduction under this section. So what this mean? where the total income of a resident individual assessee for any tax year is chargeable to tax under section 115 BAC, which we discussed. So this section, this any income which is chargeable under this section, right? So 111A. So there are certain income which is not chargeable under this section, not chargeable at slab rates. In that case, the provision says that the income doesn't exceed 12 lakh. If the income doesn't exceed 12 lakh, then 100% of tax payable or 60,000, whichever is less, is allowed as rebate. Further, to clarify, I think in this case, there are a lot of litigations happening. Then Income Tax Act last year introduced this applicable changes working from 1st April 2026. So income tax introduced following second proviso, right, on 87A, which clearly says, provided further that deduction under this proviso shall not exceed the amount of income tax payable as per the rates provided in subsection A of section 115 BAC. So very tricky language, very law language, but if you really understand this concept, you need to go through this section again and again. That's why I try to cover this. So this is the section understanding what it means. That then in this case, there is in the upper para, right? In section 112A also, it is clearly written. In 112A, it is clearly written where the total income of the assessee include any long-term gains referred in subsection A of the rebate, 87A shall be allowed from the income tax on the total income as reduced by the tax payable on such capital gain. So our case study questions answer lies in these statements, these legal language. It says that whenever you are giving rebate, you will not consider those special rate incomes. You need to exclude that. Then you have to give the rebate. And then the interesting part here is that these 5 things which I have mentioned here, when you compute total income, very important to understand this. When you compute total income, in that case, short-term capital gain under section 111A, long-term capital gain under this, winning from lottery, crossword puzzle, horse races, income from crypto trading, and these 4 type of special rate income that will not be counted to calculate 12 lakh limit. It means like, just go to the case study which we are discussing now. This case study. In this case study, when we calculate, we will do this on the this calculator of Income Tax India calculator also. So now, if we see in this case study, we discussed, like in this case, long-term capital gain on equity mutual fund 6 lakh is not available. I think everybody told me yes about this. In this case, the rebate of 87A is not applicable. Great. But now I am asking the tax which is applicable on this 10 lakh business income. Taxation which is applicable on this 10 lakh business income is on this 10 lakh income, the rebate is applied, yes or no? Please, now business income 10 lakh, in this you will get a rebate of, because now the total income is 16 lakh. That's very interesting. I'm sure a lot of you are going through this session with full focus. So I'm again explaining because it is very important. Then I'll do this calculation on income tax calculator also. I'm again asking from you that in this case, because the total income is 16 lakh, 10 plus 6, 16 lakh. In that case, he is able to get rebate on this 10 lakh? So the answer is yes. Even the income is 16 lakh, then still he is able to get the rebate on 10 lakh rupees. right? So we will cover the computation on the calculator also. So what we are discussing now in this case, just on this slide. So I'm again focusing on this slide again, that these special rates of income is not included when you calculate 12 lakh number. These are considered separately. It's only the slab rate income 12 lakh, those are counted and rebate is given to them. This is considered separate. So this short-term capital gain under 111A, long-term winning from horses, even if anyone is having 10 lakh agriculture income, suppose if anyone is having agriculture income, that is also not counted, because as per income tax, that the agriculture income is not included under definition of income. That there is some method given in the schedule to calculate the tax, agree or non-agree, but that is not given in the act. So in this case, even you have a agriculture income of 10 lakh and 10 lakh business income, still you can able to get the rebate of 87. Right. So I hope I covered this. I think we will cover on this in this case the concepts. In this case now, just we will quickly calculate. I explain the concept of rebate. I think in this case, first case study, just which we have discussed, we covered that 80 say rebate is available. Yes, zero tax in the case study 1. In this case study, the calculation is like that. I'll just do the line calculation, because in this case, how much tax is applicable? A person who is having business income of 7 lakh and short-term gain on equity mutual fund 4 lakh. So how much the taxation? Just give me 1 minute. I'll share the tool also with you also. This is very helpful to do the calculations in a quicker way. So this is the tax calculator which is given on the income tax website. For the better clarity, I'm using this. So you need to click on the advanced calculator. We are calculating for assessment year 26-27. So new regime 26-27, which we are following. And the business income is of a 7 lakh and short-term capital gain of equity 4 lakh. So we just want to validate this, that we are discussing, is it correct or not? All of you can use this calculator at home and do this calculation in a very simple way. So short-term capital gain on equity mutual fund. So that is this second. How much? 4 lakh. Then there is a business income 7 lakh rupees. So now the what law says in this case? One second. Great. So I hope it is visible to everyone. I'll just. So this is the calculation. So now there is a normal rate. So 7 lakh business income, the taxation rate of 5% applicable, slab 4 to 8, 15,000. This short-term capital gain, 20% tax on 4 lakh, 80,000 is the tax. Total 95. But the rebate is available only on this business income, not this special type of income. So in this case, the net tax payable after rebate is 80,000. So 15,000 rebate is given on the business income. Right. So this is the, I think you can just put your queries in the chat box. Later on, we will answer every query. Now I'm moving toward the next case study. Case study 3. So we will do the live calculation only, so for the better clarity. In this case, the long-term capital gain on equity mutual fund. So long-term capital gain on equity mutual fund is 112A. So section clarity is very important when you are using this calculator. Otherwise, you can't use if you don't know the sections. So 6 lakh rupees of long-term capital gain. And then the business income is 10 lakh. So in this case, on the 10 lakh, the tax is as a 40,000. And in this case, this special rate income after this 6 lakh minus 1,25,000, 4,75,000 into 12.5, the tax is a 59,375. So the 40,000 rebate which we are discussing is available on this business income. Even the income is 16 lakh, still the rebate is available, right? So in this case, the tax liability is this on 59,375 plus this, because it's very clear on the site to that in this case rebate is available even the total income including long-term capital gain on equity exceed 12 lakh, right? So great. I think we will now move to the next part, second objective. So we covered the first part of the session. So this is tax harvesting, right? So this is the second part which we are covering, tax harvesting. So when we do the tax harvesting, so like what it means in this case. So the title of the slide clearly shows loss harvesting is as a way to deliberately book capital losses. It means if you have a certain gains in the financial year, and in the March month, you need to understand that you need to pay the taxes on that. You have a gains, capital gains in the financial year. In that case, this loss harvesting help you that you can deliberately book some losses. There are certain underperforming capital asset in your portfolio. You can book losses, and maybe if you are confident about them, you can rebuy. But in that case, this set-off will save your capital taxes, capital gain taxes. So what are the rules? Rules are very simple in this. Short-term capital loss can be adjusted against short-term capital gain as well as long-term capital. So anyone is having any capital loss, short-term capital loss, can adjusted from long-term or short-term, both. This is for the same year, and you can carry forward it for 8 assessment years. That is also available. But in case of long-term capital loss, you can set off against only long-term capital gain. So this long-term can be set off against only long-term gain, capital gain. Okay, so we will cover the now, in this case, this is the first part, which is very basic, understandable in this case. I hope everybody using on this. Now the second part in this, we will cover what is the taxation of intraday trading, how income tax define this. So in income tax for intraday equity market capital trades, I'm not talking about in this first part, intraday derivative part I am not discussing. I am discussing only trading which anyone is doing intraday in cash market. Same day intraday. Then there is a no delivery. Income Tax Act section 43 subsection 5 define this is a speculative transaction. So this is not these profits are not considered as a capital gain. If you sell on the same day, buy and sell on the same day, so this is considered as a speculative. So this is considered as speculative business income. And the second is exchange trader derivatives. So future and option. So income tax in the section 43 subsection 5 clearly give one exception. So that one exception is that if anyone is doing trading in derivative contracts through exchange and STT is paid on that, in that case, that is considered as a non-speculative. That is considered as a non-speculative. Non-speculative matlab that is considered as a simple business income or business loss. Derivative trading, right? So why this is matter? I think if we bifurcate this, right? it means there is a difference in that in the term of tax treatment. So what is the difference? A speculative loss can be set off only against speculative profit. If you make any intraday loss, then that in the whole year, suppose you have a 5 lakh loss, you can't set off with any other head of income. In the coming up to 4 assessment year, if you have any gain, you can set off from intraday trading. That is for speculative. For non-speculative, you can set off with any income, any business income, any capital gain, any interest income, any rental income, any income. So this is something very interesting. Only salaries income set off against salary is not allowed. So that is the concept. I think we will, if we understand this, I think we will move to the case study. Very simple. We just recheck our understanding in this case, that what we have covered. So please write down in the chat box that if there is a short-term capital gain from debt and liquid fund, 8 lakh of rupees, and there is a short-term capital loss from listed equity share, then there is a total 11 lakh of income. So this is 8 plus 3. So the question here is set off possible? So please, I think everybody familiar with this, yes or no? So there is a short-term capital gain income is taxable at slab rate, and there is a short-term capital loss listed equity share is taxable at 20%. So this create confusion in your mind. Okay. So what we discussed just now, so in that case, the rule clearly says that short-term capital loss can be adjusted against short-term gain or long-term gain. There is no criteria that there is short-term capital gain if there is a special rate of taxation, doesn't matter. So that can be set off. Debt loss can be covered. That suppose there is a debt gain which is taxable at 30%, can be set off against short-term capital gain which is taxable at 20%. That can be possible. So the taxation criteria is not relevant. Which head it is, that is matter. Short-term or long-term, that matters in this case. Next case study. In this case, Raghu is a retired senior citizen filing under the new tax regime for financial year 25-26. So he has interest income from fixed deposit 18 lakh and loss from derivative trading 8 lakh. So in this case, is it set off, allowed to be set off? Yes, no? Derivative trading is F&O through exchange. So STT paid definitely. I explained the concept first, I think, in this case. Now, if you understand this concept that I explained it to you, that the F&O loss is considered as business loss, and that loss can be set off from any other head of income except salary. So there is a gain from fixed deposits that we can set off. There is no issue. That can be set off from capital gain, rental income, income from other source, any income, any other business income, right? Even from, if you have a loss from derivative, you can set off. So in this case, you can derivative loss and you can set off from speculation intraday loss, intraday gain. So suppose I just frame one more question, very interesting. I have a 5 lakh speculation gain and 5 lakh derivative loss. Is it set off allowed? Yes, allowed. But vice versa, it is not allowed. Speculation can't be income can't be set off from business income. But if you have a derivative loss and there is a intraday trading gain for 5 lakh, you can set off. Great. So this is the next question. I think we covered. I'll completely explain the concept now. In this case, now question again here is that the person is a taxable interest income of 2 lakh and intraday trading in listed equity share 9 lakh profit. So he just want to check from you that on this intraday trading income, is he eligible for 87A rebate? Yes or no? Please everyone write down. Please participate. I think there are good number of participants. Intraday trading is a speculative income. Great. So as we discussed that this income, intraday trading income, is part of under business income. So we discussed now in the income from business and profession. This income is chargeable under section 115 BAC. So this, if we calculate this section, this 115 BAC, in this case, intraday trading income taxation is as per these marginal tax slabs. So if the taxation is under 115 BAC, it means rebate is allowed. It is not a special type of income, right? So this is a special type of business income, speculative income. Still, it is eligible for rebate. So in this case, the answer here is, in this case study, the answer is rebate is yes. So this case study answer is, in this case, zero tax. So that's very interesting in this case. So we covered second and third objective now. Now the last objective for the today's session, right, which we are covering. So this is like a specific strategy which generally we recommend. Like there are 2-3 sections of income tax applicable in this. First is a gift. So in the income from other sources, there is a deemed income. So there is a section of 55 or 56 in this case, which explain that if you give gift to any of your relatives, then there is a no transfer applicable. So there is, in the hands of recipient, there is no income counted. So that definition is like anyone, relative definition. I said this is a broad definition given in the income tax for relative. So which include minor child, major child, spouse, parents, any relative. So this is the broader definition. So in the recipient hand, the income is not taxable. So how this tax strategy we designed in this way that first, so suppose in this case, like this is the first part. So gift to a minor. Now the second part, when we suppose anyone transfer, in this case, 1 CR in the name of minor, example, and do the investments in a debt growth fund. Because if I am investing in my name, maybe in the debt fund, or maybe in this case, down the line, I need to pay a slab rate of income. But in this case, if I am transferring, so I have any FD maturity of 1 CR, and I am transferring that 1 crore FD in the name of minor and invest in debt mutual fund as a guardian, investment in the name of minor under guardianship, then in that case, in the debt growth fund, right, there is no income till the time redemption. So there is no taxation applicable till the time you redeem. So suppose as an example, a 15-year minor child, you made investment in his name, then till he become major, the growth which is coming into the debt growth fund, that is on the accrual basis, that is not taxable. That is taxable on redemption basis. Then the third step is when if redemption happen after the child attain majority, 18 years, then in that case, the clubbing context, because there is a gift tax, there is a no gift tax. But if in the minor stage, if you do FD, then clubbing, that FD income will be clubbed in the guardian's income. But if you do investment in debt fund, then when the child become major and do redemption, then the taxation implication comes into that major child case, major son case in the case. So in this way, this is a legal tax strategy where, like in that case, so minor when the becomes 18 year of age, right? Then in that case, he can redeem the units up to the 12 lakh rupees of capital gain and pay zero tax. So I think we explain the concept also. Just go through this case study for more validation. We already, I think I explained this concept along with this case study, that if Mr. Rajesh, 43 years old, is in 30% tax bracket, liquidated 1 CR fixed deposit and transferred to his 15-year-old son. So there is no gift tax. Then in this case, the second part, these funds were immediately invested in debt mutual funds in son's name. So this tax deferral instrument, tax payable on redemption, so that on 3 years there is no tax. If this becomes an FD, the tax is there, but in this case there is no tax. And when in case of debt mutual fund for any duration, the tax treatment is short-term capital gain. This is in this debt short-term debt fund is falling under. So suppose you invest in debt fund in the hold for 5 years, still that is counted under short-term capital gain. And short-term capital gain is taxable at slab rates. And the slab rate is eligible for rebate up to 12 lakh. So in 2-3 years, in this case, right, you can maybe redeem your investment growth part at a 0 level. Great. So in this case, when this strategy is applicable, even anyone becomes major. So, but this is something very interesting, because if anyone is major, then that kid becomes their own income also. So this is more relevant because in the minor phase, there is no such income. And in the initial year of majority, there is no other income for the child. He is in the education phase and he can take the advantage of 87A rebate of 60,000 through these debt investments. So that's all from my side, Alok sir. So maybe you can proceed with the questions.
Thank you so much, Harminder. Definitely very insightful session from your side as always. And I think what I liked most was, the way you put the situations, converted them into case study, and they look very simple, but they all had, some minor point which was so crucial for that and understanding through these, 11A, 111A, and 112A and 112 is very important, because unless and until you know these acts in and out, you won't be able to really understand, comprehend, and arrive at the right solution to it. So understanding these acts is very important, which you also narrated and which you also covered in your presentation. So that was excellent point, which I thought. And let me just see the chat and some sessions. So one gentleman has asked that if you can guide, suppose while buying an equity stock or fund, we have not paid STT, but we have paid STT while selling. So I don't really understand, if you are buying also through an exchange, STT is debited or paid automatically. There is no way out wherein you cannot pay STT. Harminder, would you like to elaborate on that point?
Yes. So this is in certain scenarios, So 112A section application is related to acquisition and transfer. Both cases STT application is there. So in case
Yes.
at the time of acquisition, there is a off-market transfer and the STT is not there. So it means the 112 application would not be there. So
It's
what is the
not within.
implication? What would be the implication of this? So only there are two exceptions, IPO or ESOP. These are the only two options where you can get escape route that STT is not there. In all other cases, this 112 application is not there, and the irony of this is that in this case 1,25,000 reduction and this grandfathering rule benefit both will not be applicable. So that is very important to understand if there is a no tax STT on this acquisition.
Yeah, thanks. That's well clarified. Another question I have, Harminder, is that can FNO loss be set off against lottery? I mean, you narrated, the FNO loss can be offset with so many types of incomes except the salary.
No,
So here is a
no set
question
off
where
is
it can
possible.
be. Uh,
Those income which are falling under special rates of income है ना, जो हमने अभी इसमें देखा ना, उनमें ना, so there are virtual crypto trading income or maybe there are certain income which is taxable at flat rate. Even basic exemption limit is not available. So as per my understanding, even set off is not there.
so no FNO set off against lottery then. Clear cut. I'm just scrolling and if I can locate some more questions. So those who have requested for, the recording of the session and all, I mean, I would like to say that, this will be available on FPSB India YouTube handle also. We will be inserting questions there and then it will be available on the handle, maybe about a week or 10 days time from now. And you can watch this n number of times and you can maybe, and I am sure all of you know Harminder very well, so you can post a direct query to him or to us. And then once you have done those 3-4 questions embedded in this webinar, you will be eligible to get that 1 CPD point also. So that's it. I don't think, let me just check again. So here is one more question which has come from Neha, which says that clubbing of income in case of housewife made investment by the husband money. What are the tax provisions? So clubbing of income in case of a housewife made investment by the husband money.
Okay, so income tax clearly says in the clubbing of income, in there are total 5 cases. I think in a just one liner statement, there are 5 cases of income: one minor child, second spouse, third daughter-in-law, fourth HUF, and fifth revocable trust. So if anyone transfer any money to these five persons in that case, clubbing will be applicable. These 5 scenarios. So I think housewives coming under spouse.
Correct. And minor child, of course, is there.
Yes.
Which you also
minor
discussed in
child
the
is there. Yes, that's the case study clearly explained on that.
Yeah. So thank you so much, guys.
So people asking for the link of calculator, I think for the sake of convenience, can I post for, because they can utilize more effective way?
Yes,
Just give me
do
1 minute.
please. You
I'll
can
post
put it
the
in the
link.
chat.
Just
Please
give
put
me
it
1
in the
minute.
chat.
Maybe people can use this. This is very important calculator.
Put it in the chat, please.
So I posted in this. Please, आप लोग इसको, you can just take this. I think we can wait for 1 minute. I think people can just copy from there. Maybe they are not able to.
Yes. We are there. No
One
problem.
more minute. Just please copy this link. You can use this for your daily tax calculations.
Till then, Alok, sir, I think we have one question from Om Goel. Have we answered that
Yeah.
about the last case study? Yeah.
I could not locate it. In case you have, please post it, Rutika. No worries.
Sure. So, the gentleman is asking, Harminder actually, that the investment which was made on debt fund before April 2023, would that qualify for LTCG and can it be taxed at flat 12.5%?
Yes, matlab any investment which is done before 1st April 23 and in that case redeemed any time, है ना? In that case, the criteria in that case is that minimum holding period would be in that case three years. So in that case, if it is holding for 3 years, in that case, that is considered as long-term capital gain, and in that case, 12.5% tax is applicable, not slab rate of taxation. Any investment post April 23, that is considered as short-term capital gain for any duration.
Okay. Okay, sure. Thank you.
Okay. Thank you. Thank you so much, Harminder. And thank you
Ji.
everyone for joining us today in this webinar. And, very useful insights from your side. I'm sure people are going to benefit a lot by these, small items which are there, which keep on cropping up as we interact with the clients for their investments and so on and so forth. And why not for our own investments sake also. So thank you so much, Harminder, and good day to everyone. And bye-bye. Thank you, Rutika, for
Thank you,
this
everyone.
session.
Thank
Yes,
you, Alok
thank you.
sir. Thank you for
Thank you.
this session.
Thank
Thank
you.
you.